Hello everybody, Luke Gromen, founder and president of FFTT, Forest for the Trees. Thanks for joining me on a Sunday night with two things that have grabbed my attention recently. I'm going to whip through those really quickly and then we'll open it up for questions for a bit. First, a quick thanks to everyone joining this on the replay. Glad to have you checking it out. The first thing that grabbed our attention recently, of course, with this being the 10-year anniversary of the real the real kickoff of the financial crisis when Lehman went bankrupt, there have been a whole number of reminiscences, easy for me to say, about the crisis, what caused it, what may have caused it. You've had a number of different officials at the time weigh in. The thing that really grabbed me, and we tweeted about this, is that crisis ultimately, in our view, was about institutions, lent, and those institutions, U.S. commercial banks, U.S. public pensions, lent a bunch of money to people that couldn't pay it back. And when they began defaulting, once we hit a critical tipping point, we had a big crisis, of course. What grabbed me about all these reminiscences were the lack of recognition by a lot of these officials that what we have going on now are commercial banks, public pensions, lending a bunch of money to people who can't pay the money back, except back then it was U.S. and global, U.S. homeowners were the center of it. Today, the people being lent money that can't pay it back are sovereign governments, particularly in the West when you look at the fiscal situations. And so the difference this time is that homeowners in the United States did not have a printing press with which to pay their bills. Western sovereign governments do. And I think a critical thing to highlight is the breakout on a 25-year chart of the S&P 500 over the TLT that began shortly after Donald Trump got elected. We continue to think that's a big thing to note. So that's the first thing. The second thing just came through this afternoon, and it was news from the Wall Street Journal that China is not only saying pass on proposals to meet again with the United States, but more importantly, reportedly considering beginning to restrict shipments of critical components to U.S. industry. This to us is very interesting because by and large conventional wisdom and the overwhelming narrative in our eyes has been that the United States has most of the cards / all of the cards. China has very few cards, and therefore China will cave just at any moment. And yet, as we've been saying all summer, continue to say, China's not going to cave. It's a matter of national security for them not to cave. It's a matter of the United States national security for China to cave. And so it's a very important, I think, potentially milestone in the trade tensions between the U.S. and China. If this story is, as it develops, we are definitely going to be watching it. I think some of you know I was an Eagle Scout, did a number of high adventure backpack trips in parts of the world where if you get hurt, nobody's coming. They're going to come get you maybe with a helicopter, maybe in a couple of days. And the point being that, a famous Marine general said that amateurs study tactics, professionals study logistics. And it looks like maybe China just sent the first shot across the bow of getting U.S. economic analysts who have been primarily focused on the tactics of the trade war and maybe getting them to spend a little bit more time on logistics. So we'll see how that plays out. And so those are the two things that really grabbed me so far as we head into the week. While we're waiting here to see if any questions pop up, I would encourage you, please take a look at our website. We are opening up the FFTT tree rings product. Would love to have you, quote unquote, inside the ring. It's if you enjoy these podcasts, I think you'd really like the tree rings product. So check that out. So we're going to see who's asking any questions, and we'll go from there. Let's see. Thanks for doing this. Gold oil ratio about 16. Yuan gold oil ratio also about 16. Yeah, I think it's an important thing to watch, as we have long speculated that the successful launch of a yuan oil contract ultimately begins to give China the ability to manage their own oil and ultimately other commodity import bill through a ratio of gold to oil. Ultimately, by doing this, they also gain the ability to manage physical flows of oil, physical flows of gold, and by extension, the international trade value of the dollar through those commodities. And so at this point, you're not seeing any difference between the two. The one thing I would note is keep in mind the gold market is a very interesting market. In other words, the gold to oil ratios are similar. The implied leverage in gold markets in the West have gone up markedly in the last 2 months. And so you can see the leverage in the gold market rising notably in the last 2 months, and so that is something worth noting. The physical flows have accelerated eastward. There was an article, we retweeted it last week. UK trade stats are benefiting significantly by exports of gold. The UK has no gold mines, and so that is gold leaving the vault. And so at this point, you are still seeing the gold to oil ratios remain parity, but underneath those gold to oil ratios at parity, I would highlight that you are seeing physical flows that are telling a bit of a different story in our view. Let's see. Marv, my view on Yellen's comments for policy in the next downturn. You know, I thought her comments were really interesting in terms of why now, in terms of this was, Ms. Yellen made comments a year ago that she didn't think we would ever have another crisis or something to the effect. And I don't think that's literally what she meant, but she felt very good about the ability to manage it. And so, you know, there seems to be, I don't know that her comments are particularly different from what we've seen over the last 15 years. Or you go back to when the equity market bubble burst back in 2000. You know, you had a number of different neoliberal economists. Most famously Paul Krugman talking about that Greenspan needed to create a housing bubble to replace the lost aggregate demand from the stock bubble. And so I think this is something they have talked about as policy in the past. I think it's part of what the goal was with QE. When you look at the number of times the stock market, rising asset prices were cited as either beneficial outcome of or a goal of QE. I don't know that it is a difference or a change in opinion or policy from Yellen and Fed officials, but I do always find it interesting when they decide to say certain things, when they decide to say certain things. All right, let's see here. Looking to see if there's any other questions from people. Not seeing anything else. Hey, Eric Carlos, how you doing? Good to see you. I'm glad you joined. I'd love having you join. That's excellent. Also, hello to Bill. Let's see. Given U.S. August deficit TBAC roll, I say the situation has accelerated. Has it accelerated months? Has it accelerated years? Weeks? That is a great question, great point. I think, I talk about tactics and logistics in light of what we were talking about before with the Chinese move. I thought it was really interesting. I thought it was very interesting that this comes right on the heels of the August U.S. deficit numbers, which were, in a word, enormous. $214 billion deficit. There were some seasonal impacts with how Labor Day fell, and so because of how Labor Day fell, there was a little bit of move of Social Security spending into August. That said, it's a huge number, and this is with GDP running 4 to 5%. We've been looking at numbers, and there's a number of different ways you can model it. Obviously, there's a lot of inputs, but we have been consistently in the last several months, seeing deficit numbers, thresholds being crossed that we thought. So a perfect example, one of the things we track is entitlement spending plus defense spending plus interest expense. Though the big three the U.S. spends all their money on. We thought that number without a recession would hit 100% of U.S. tax receipts by about the end of 2021. Under a mild recession case, sometime between now and then, we thought it could reach it by early 2019. Those big three hit 103% of U.S. Tax receipts in June. So we're 9 months ahead of a recession case. We're 3 years ahead of a non-recession case, and that's with 4 to 5% GDP growth. So, some of that's because of the tax cuts. But again, as someone asked last week or a couple weeks ago, the tax cuts were supposed to pay for themselves, and they're not. So we'll see if that changes as we get some, stock benefit tax receipts early in next year. But at this point, it's not happening. And so when you ask how far is it being pulled ahead, in some cases it's years. And so when people say, well, we have years, I'm not so sure that's the case when you start looking at some of the speed with which some of these deficit numbers are rising, the speed with which interest expense as a percent of GDP is rising. So it's something to watch. Let's see. Why the change of mind on emerging market assets? Won't we get a correction in U.S. stocks before that? My change of mind in regards to dollar emerging market assets, after we had gone tactically neutral to positive on the dollar starting in March, and more recently changed that view. It really is tied to what we're seeing on the U.S. fiscal side. It is the speed with which it is deteriorating in a 4 to 5% GDP growth economy and 3.9% unemployment or whatever the number is economy. We were concerned and we're looking at these numbers, and it has surprised even us the speed with which some of these things are evolving. And so, our case all along had been that it seemed very possible to us that there was nobody more sensitive to rising rates and a strong dollar than the United States government. No one was more short dollars than the U.S. government. You've probably heard us say that. The data are coming in, and it's looking like that's the case. And that ultimately is why we are a bit more, we're more constructive on emerging market assets. We just think that the deficit side is going to force either the Fed or however it's done, a softer dollar before people think. Great question from Eric Carlos. To you, what does China caving to the U.S. look like in a very practical sense? That's a great question. Look, to us, China caving to the U.S. ultimately requires, I think, some sort of nod towards moving back towards the status quo or the prior status quo system where China saves more than they need to or reinvests surpluses into U.S. financial assets and treasury bonds specifically, or does something that ultimately maintains that status quo, which requires, the word used in Chinese media was China to become, restore a position of being an economic vassal to the United States. And so, we're now getting into a part of this movie, if you will, where the sides are talking at each other. I'm not so sure they're talking to each other. And that's a little disconcerting, of course. But that, to me, I think is, if we take a step back towards sort of the prior status quo system, regardless of how big that step is, I think that could be, that could be allowed to be spun here as China quote unquote caving. The challenge, of course, is that when you're negotiating with someone, you don't, if you get a victory, you don't want to sort of rub their face in it. And I'm not sure we have the officials or the media in place here where we wouldn't do that and sort of spoil progress that we might otherwise make. So it's going to be interesting to see. Would I comment on Ray Dalio's recent statements? Absolutely. I thought that was a very fascinating interview he gave on Bloomberg. For those who didn't watch it, you can certainly check our feed. It was also circulated pretty heavily on Twitter, where Ray Dalio said, look, within 2 years, the U.S. fiscal situation is going to deteriorate to a point where we're going to need to issue more treasuries than we can fund domestically. The Fed's going to have to step back in with QE, and that could lead to a depreciation of the dollar. And when pressed, he said it could be up to 30% depreciation of the dollar. Everything he said makes sense to us. It would tell you inside baseball read on Ray Dalio. Obviously his track record speaks for itself. He has one of the bigger research budgets on Wall Street. You would think, and so this is somebody who doesn't need to make these types of positions or these types of statements. For any reason, what we think he's seeing is what we've been seeing, which is what he's talking about. I'm sure he's been seeing it as well, and he's now talking about it, which we think is a big hint on timing. I think he sees the untenability of the U.S. fiscal side. I think he sees the speed with which the untenability of the U.S. fiscal side is rising and is highlighting that. Let's see. Would I be a buyer of commodities of gold and silver at this point? The short answer is yes. The commodity markets, and in particular, I think gold's the easiest one to highlight this for. We have highlighted this for. I think the commodity markets are in a bit of state of flux, broadly speaking, in terms of with China doing what it's doing in terms of trying to gain the ability to price and settle oil in its own currency. It would be the first nation able to do that ever, other than the U.S., certainly in the last 70 years. And so you have these large commodity derivative markets, heavily levered to varying degrees. Physical supply, the game China appears to be running is effectively, something we've tweeted a number of times, probably ad nauseum in some cases. You take the dollars, we'll take the commodities. They are exchanging dollar surpluses for physical commodity supplies, both in present and in the future. A recent $22 billion LNG deal they just signed with Qatar, a perfect example of that. I think that deal was last week. The point is that ultimately, the strategic value of these commodities of gold, of silver, are likely to be recognized, and I think in a meaningful way. I think they are significantly undervalued. That said, I think part of the weakness we're seeing in commodities, have been sort of being in between two trapezes of, if you will, of moving from one system where you have these highly levered dollar-denominated derivatives contracts setting pricing towards a system that is different, or even just a second currency, multi-currency. And so, I don't know that you want to own them for a trade here. I think they are sort of buy and hold. You put them away, and I think if you wake up in a couple of years, you're going to be real happy. Can I explain what I mean by no one is more short dollars than the U.S. government in very basic terms? Absolutely. You look around the world, who has the biggest debt in nominal terms in the world? It's the United States government, and it's not even close who's number two. The United States owes $21 trillion federal debt. The United States owes somewhere between $100 and $200 trillion in entitlements. And like I said, nobody's even close. The other thing is the United States economy is arguably more financialized. Remember, we have sent a lot of our production assets overseas. We have instead focused on technology and in finance. Between finance being interest rate sensitive, between the importance of asset price appreciation to the United States GDP growth, whether it be housing, whether it be financial assets, it is simplistically said, the United States is short somewhere between 120 and 200, $200 trillion. And most importantly, they need to roll between 7 and 10 trillion of that every year. By way of comparison, the roll annually for any of these emerging markets is a small fraction of that 7 to 10 trillion dollars. And so that's what I mean by that. Might have been asked, but please comment on China striking at U.S. just-in-time production. Hi, Andrew. Good to see you. It was one of the two things we highlighted was this Wall Street Journal headlines today noting that China is talking, they're basically striking at logistics, at supply chains. And I think it is potentially a very big deal to watch. It's a very important potential escalation. And I think it is going to start getting, maybe it will start getting people and economists and analysts on the financial side in the United States to begin thinking about logistics for the first time probably ever in their careers. It's just a given. You order the stuff and it gets here, right? You get online, Amazon.com, you order it, and 2 days later it shows up in a box. And it's been a long time since anybody in the United States has had to think about logistics. How does it get here? How long are our supply chains? How vulnerable are our supply chains? Amazon is a great business in a world where you are trying to pull inventory out of the system and where you are trying to lengthen supply chains and get things just in time. You're leaning out the entire system. Great business for that. In a trade war or, God forbid, wartime economy, Amazon is a liability. Your supply chains stretch all the way back to China, etc. And if any link in that chain breaks, it's a problem. And instead of the United States having inventory of goods, both discretionary and non-discretionary goods, in stores, in local distribution centers and stores all around the country, they're increasingly centered in a few Amazon distribution centers all around the country, not that many. And so again, it's very efficient in a non-trade war, non-wartime economy. It's a huge liability in a trade war. And again, no one's thought about these things. One of the things that got us thinking about it was reading The Raven of Zurich, where, as it became apparent to Felix Sommery that World War II was going to happen, he began making quiet trips from Switzerland to the United States and began signing long-term supply deals of physical commodities in secrecy so that Switzerland wouldn't starve. And so it was one of these things where when you look at it through that lens, you begin to see things completely different. Things that were great in a peacetime, lean out the supply chain economy, things like Amazon, things like what we've been doing for the last 20 years in terms of lengthening supply chains, at some point, like I said, God forbid, become liabilities. What is something that I believe to be true that nobody agrees with you on? That is a fantastic question from A. Burdett. I think the fiscal side accelerating to the degree in which it does is probably one. I think the physical flows of gold doing what they're doing being an important signal. But in both of those cases, I think it's important to note 2 years ago, nobody would have agreed with us. The people are starting to sort of ask a lot of questions in that way. And so nobody agrees with me on, I don't know that there's something I've got that is there, but I think, the U.S. fiscal situation, and I think, that was part of the reason why I thought what Ray Dalio said, as explicitly as he said it, where he said it on Bloomberg in front of the audience he would have in saying that, I thought was a potentially big moment, right? It's one thing for me, FFTT to say, hey, have you seen these U.S. fiscal numbers? This is turning into a problem sooner than most people think. It's an entirely different thing for Ray Dalio to say effectively the same thing. And so that might be how I would probably answer that. Sounds a lot like negotiations with Mexico in preparation for war with China. I hope that's wrong. But I'm also not I'm not naive enough to think it's not impossible. I mean, if you say, hey, Luke, what would you do knowing what you know and with your lens of the world, what would you be doing? And I would be trying to cozy up with Mexico and China and try to reestablish very firm supply chains, particularly, as Eric Carlos points out, Mexico, where you've got a long-term history of working with them. Your logistics are much closer. You're shrinking that supply chain. You're making them more robust. You're still getting a cost advantage. There's a lot to be said there. So, all right, guys, I'm going to finish up here. It looks like there we go. Let me see. One more question I'll take. When the oil trades away from the American dollar, it's very bad for us. It's over. What do you think? I don't think that. Ultimately, the dollar collapsed against oil from 1999 or 2000 to 2007, 8, right? I mean, oil was $10 a barrel and it went to $150 a barrel. That is a collapse. Once it got to 150, I think it definitely caused problems or contributed to the financial crisis on some level. But I don't think there's any economist, any politician, most Americans, I think, would say, boy, the shale sector is a net negative for the United States economy, for the United States geopolitical strength. And so to me, I look at the United States, at the right price, we can produce just about anything we need. And so when you say at the right price, that then ties back to the dollar. And the dollar is structurally overvalued as a function of its reserve status. If something on that changes, whether it's via trade deals, currency caps and trade deals, some sort of plaza accord, there's a lot of different ways you could do it. To me, you're talking about a vicious sector rotation in the United States, no question, but I think the U.S. ends up better for it, not worse for it. All right, everyone, I'm going to check out here. Thanks for joining me, as always. Again, if you enjoy these podcasts and these periscopes, feel free to check out on our website, FFTT Tree Rings. If you're not a member already, it's a subscription service, and we do thoughts on 10 different stories that really grab our attention throughout the course of the week. We've been getting great feedback on it. Would love to have you inside the ring. Otherwise, have a great rest of the night. Have a great week, and look forward to catching up next week. Take care, everyone.